last few years, I've been fortunate enough to build up a double-digit property portfolio. And it's during this period that I've had to develop my own knowledge and navigate through a whole host of challenges and mistakes. But the reality is, if I can do it, then so can you. This Property Market Investor Expert Series has been created so that you can learn from the mistakes which might otherwise be made along your journey and open up your knowledge to identify investing opportunities which you may have otherwise not even been aware of. Today I'll be meeting with Scott O'Neill, the Your Investment Property Magazine Investor of the Year for 2019. With a current property portfolio of 29 properties worth $18.5 million, Scott is one of the most successful young property investors in Australia. So what is Scott's strategy? Scott's strategy, an area of expertise, is investing in high cash flow positive commercial properties. Let's find out from Scott more about his successful strategy. Hey Scott, how's it going?
Very good, mate.
How did you get started in property then?
I started back in 2009, so
Yeah.
I was saving like everyone for a deposit. I scrounged up, it was about 55, 60 grand at the time.
Yeah.
Took 4 years, 2 jobs, like I was working through uni.
Yeah. And throughout that entire 4-year period, you had the sole objective to save for a deposit.
Yeah, and even like I did travelling, and I was even working when I did travelling as well. So it allowed me to save that deposit.
Yeah.
And at the time, Sydney was quite beaten down. It was right after the GFC.
Yeah.
And they had the they was doing the LMI with no LMI on 90% loans back then. So I got into that. And
did you need to pay a stamp duty?
No, they waived it because they had the first homeowners grant. So similar to what they've...
No stamp duty, just 10% and then you're in.
Yeah, plus other little costs, but similar to what it is now because they got the first buyer incentives back. And
Indeed, yeah.
So a similar situation, and it allowed me to get the foot in the door, and the rest was history. I didn't buy for another 2 years though. After.
Was the intention with that first one principal place of residence only?
It was an investment, so I had a house in Granny Flat. I never wanted to live in it. I actually did though to get the first homeowners grant.
Yeah, so 6 months and were you gone?
Correct. Yeah. So no, I did the job.
Yeah.
Saved all that stamp duty.
Yeah.
And foot in the door. So it was a good experience.
At the time of purchase, what sort of price range was that?
It was $480.
$480.
Yeah, $480.
And what suburb was that?
In Sutherland, Sydney. In Sutherland Shire.
Yeah, and that had a granny flat as well.
Yeah, and like nowadays it's worth sort of around the 1.1. And that one property was a game changer.
Yeah, that's what facilitated kind of the release of equity, and I imagine for you to get back in. So you waited 2 years?
Yeah, 2 years because I had to save basically most of the next deposit because the 2 years after I bought it in 2010, the next 2 years in Sydney were pretty poor. They didn't really grow. So.
Was it just after the downturn, so maybe a flat period?
Yeah, there was a good 2 to 3 years of flat period, and it made it hard for that next deposit. So I wanted to buy sooner and quicker. I was impatient. I was only 23 at the time, but had to wait, had to save, and eventually my wife and I got together. She brought a small part of the deposit as well because she was working, so we combined and bought another one in Sydney, in Maroubra.
Okay. And what sort of price range was the Maroubra?
$620.
$620. Was this a unit or a house?
2-bedroom unit, 2 bathroom, one of the ground floor garden type ones. So we bought that to live in. We actually lived there for a couple of years because we wanted to be in the eastern suburbs, but we wanted a small backyard. And it really got lucky with that one. It was cheap. That one grew to about $1 million over the next 4 years, but then it fell back because it got hit quite with the recent falls.
Indeed.
And
fair enough.
Went to about $1 million, came back to 900.
Yeah. So you really started off from the offset with an investing objective. You know, like you're buying a good quality investment property with a granny flat at the back. So obviously you get the cash flow and then you move straight into your second purchase. What was it that kick-started that desire to build your own personal wealth?
So it was just my job. I didn't like working long hours. I was engineer doing, we're building railways, so that meant you work Saturdays, Sundays often, Christmas.
Oh, wow. Yeah.
So it was a bit of an idea, like let's just build a bit of an income on the side. If I could bring retirement 10 years earlier, that's a win. There was no real set in stone goals. It was just buy a good quality property, long term it's going to be good.
Yeah.
So it, that second property was not part of that strategy. That was an emotional choice. We wanted to move, together somewhere.
Yeah.
the third property went back to the strategy of buying good cash flow. We bought a unit block in Port Macquarie.
And how long after the second property was that purchase?
That was another year or so. So it was quite slow, or not slow moving, but
it
wasn't going
compared
rapid.
To your recent exploits, then very slow.
So that, we had these 3 properties over a 4-year period ish, and then the third one was 4 units on one title, so we paid $425 for that. That was renting for over $800 a week, so $200 each place. Wow. So that was great cash flow.
Yeah.
And that's where it started. I was like, well, I can buy these properties. They do grow in value, but they also give you cash flow back.
Indeed. How did you fund the deposit for that one? By this point, had the original property in the Sutherland...
That was starting to rise.
Okay, so that, rather than save the deposit like for the second one, you were able to refinance, draw out equity and then use that as the capital?
Correct.
Did you have to chuck in any of your own funds?
For that one, no. That was purely Sutherland started ramping up and had the deposit.
Yeah.
We bought well at Maroubra too, so... That was, again, that's where it all started. I go, well, I can use equity to purchase future properties. I can buy a property that gives me cash flow.
Yeah.
This actually works. Before it was just buy and wait and see.
Yeah.
And then the next one, we bought another unit block, and that was where the actual defined strategy started. And then that led into, purchasing commercial properties, more unit blocks. We scattered a bunch of houses in Brisbane for growth, for long term as well. So. Always wanted to create a deposit and good cash flow.
I see. And do you do that from different assets? So maybe you'll purchase a couple capital growth properties for X number of cash flow properties?
Yeah, so we look at, as a bit of a ratio, you want 2/3 of your portfolio in capital growth areas. And then the 1/3 is just going to be that big cash flow injection, whether it's a commercial or high yielding duplex, something like that, but that will balance out the good growth ones. So you might go like a middle ring suburb of Brisbane in today's market. That looks like it's got good promise.
Yeah.
But you don't want 10 of those because the cash flow would be neutral, but then if you're leveraging, it's going to be negatively geared.
Yeah, indeed.
So you need those other pillars of cash flow to make it self-sustaining.
And was this a principle that you developed at this stage, or is this something that has been more recent, you've kind of defined and refined?
Look, it's more defined now, but it was followed back then. So I just like the idea of making sure I didn't get into a cash flow hole, because at the end of the day, I didn't want to work forever. And every 10 grand I made through cash flow from extra rent, that was just 10 grand off my income that I had to earn. So that was where it got exciting, because it was replacing income to the truest sense. So, but we can't neglect growth, because if you just go all out cash flow, you're going to buy a few properties, depending on your salary, and then you're finished. And you need to keep it rolling forward, and growth is how you do it.
Was it literally by trial and error that you learnt this, or did you, was any of your family members investing in property? How did you kind of develop that knowledge?
Look, it was just through spreadsheets. So family, they were, they did invest, but in a different strategy. So they did the standard baby boomer style, where you buy a 1/4 of an acre block in Sydney, sit on it for 20 years, you do very well.
Yeah.
But it was too expensive for me to follow that same strategy, because it's 13 times the average income, give or take, to buy the average house in Sydney.
Yeah.
50 years ago, it was 4 or 5 times. So it's a strategy that I almost got forced to follow, because I wanted to keep lending going. I wanted to buy affordable houses, because I didn't want to overcapitalise. If I had $1 million lend, I'd rather spread that over 2 smaller properties with 2 different rentals, 2 different markets.
Yeah.
Just felt safer at the time. And it allowed you to get a better yield too, because the cheaper type prices generally have a better yield than going perfectly blue chip, negatively geared properties. So having better cash flow allowed me to build a larger portfolio than what I otherwise would. And I've followed that ever since. But now I'm more skewed towards more cash flow. So these days I'm only really buying commercial, because
I see.
Commercial is, I don't really care too much about the equity as much, because I've got a good foundation of properties. But I want that cash flow really growing, because that's what you live off.
Yeah.
I don't want to live off equity. To me, that's dangerous. The equity's there to create another investment.
Yeah.
I wouldn't want to draw out equity to spend it on a holiday.
Personal. Yeah. Okay. So do you think that is a rule of thumb that investors should apply to their personal circumstance? create a foundation portfolio first and then move into cash flow?
It depends on the stage you're at, but I think young investors, I think it's smart to create a foundation portfolio. It's low risk. You can jump straight into something like commercial, but you'd really want to know what you're doing.
Yeah, okay.
The level of due diligence you've got to do on an asset in commercial is probably tenfold compared to a house. So
indeed.
If you've got that knowledge, great. If you don't, you could seek professional help or, just do what everyone else does and buy a house or two.
Yeah.
And then learn how that all goes. Read the markets, go where the tenants want to go, where the owner-occupier percentages are high. Because everyone lives in a house, it's quite relatable, which is a lot easier to understand compared to understanding, a type of business you've never been involved in.
For sure, yeah, indeed. Do you know of or have worked with any investors that have built up a portfolio entirely of commercial properties?
Nowadays, probably one out of three of my clients are just only commercial.
Yeah, wow.
Particularly ones over 50.
Yeah.
They generally see that they want to retire in 5 years, say.
Yeah, okay.
So you don't really want to sit in a market for 15 years waiting for capital growth with the hope that it grows and then you can sell it off and enjoy some of the cash.
Yeah, indeed.
They rather just go straight into good quality commercial because the cash flow is measurable year one. You can see it. There's a tenant in place. It's a lot more predictable, I think, when you buy the right type of tenant. This is an extreme example, but think about a supermarket on a 15-year lease. If that's a $200,000 a year income and they pay all your outgoings, they're going to pay $200,000 next year.
Indeed, and there's probably an increase like 3-4% each year.
And you can see it on paper. It's a contract. So there's a lot more, or a lot less, should I say, guesswork when you buy those types. Commercial, you can get it wrong, of course. Like, if you went and bought a Toys R Us shop recently and that went under, it's not a good story. But,
indeed.
But, that's where I really look at the, relatability of a property, and also the viability of that industry over a long period. And, that I think if you can, a lot of clients are sort of being more interested in that of late because the interest rates for commercial lending and residential are quite similar now. The growth in many residential markets looks less promising than it was a few years ago. Like Sydney and Melbourne, they're still falling technically now as of today. So people are looking for returns over the short term, and there are returns in the short term through commercial because there is inbuilt increases in the lease and stuff like that.
So is that what determines capital growth for a commercial property? If, for example, in the lease agreement there's a 4% annual increase in rent, does that mean that the value increases by 4% each year of the property?
Roughly. And then but there's other factors. So there's like the cap rate for the local area. So that's
what's the cap rate?
So let's say you're looking in Brisbane's average cap rate is 5%. So 5%, divide the rent by 5%.
Okay.
That's going to be the purchase price. So when interest rates drop, let's say they drop 1%. All of a sudden 4% might be still acceptable because they're still making the same margin. So interest rates dropping actually creates capital growth for commercial. So this is quite an opportune time for investing in commercial because we're seeing rates dropping very low.
So you got to get in quick, right? If rates are, as we believe, to drop again in October and maybe once again in February, you can build immediate capital growth in your commercial property.
Exactly. And it looks you got to remember it goes the other way too when interest rates go up.
Fair enough.
So, but like looking at the sort of long-term forecast for interest rates, like it's a low inflation, economy. It looks, by all accounts, like they're not going to go up anytime soon. And globally we're in a low interest rate environment. So if you can go lock away like a 7%, 8% net yielding property on a 10-year lease, or even a 5 or 3. That you're feeling pretty safe with that type of investment.
Indeed, So do you believe that for your personal portfolio moving forward that you will deal with entirely commercial properties?
Personally, yeah. So I just, for where I'm at, I think I've got I'm probably, I've got a lot of residential already. I've had it. I'm just waiting for the growth. Like, for example, I've got, around 6 or 7 properties in Brisbane. I think Brisbane will have a very good 5 years. If they all grow, I'll eventually refinance them. And then maybe purchase a very good quality commercial property. If I pull out $500,000 in equity, that's a deposit for a commercial. You might lend up to say 1.5 million on a commercial.
Yeah.
And you might get a multi-tenant type asset in that price range. So that's sort of where my head's at. You know, I like the idea of commercial because it is a better cash flow. And,
indeed. Yeah.
You know, I like the style of tenants too because think about a tenant in commercial versus residential. Like a commercial tenant is a business. You know, they're online, they've got a reputation to uphold, a brand, an image. They're more likely to behave and pay long term as long as the location is viable for them, right size, etc. Then you generally will get more consistency from it.
Indeed.
And when you do the right level of research, you can actually look into that deeper than others, and you know, it's a lot more predictable, I think, compared to dealing with residential because, you know, people change their mind. You know, I regularly get a house, you know, trashed almost because I've got a lot of them. So, you know, I have the problems, and as I sort of get more, you know, long down this track with investing, a quiet day is a good day, I feel.
Oh, definitely. The less you hear from the rental manager, the better.
Exactly.
Which, I mean, I suppose that's a great segue. So, rental management, you've got quite a large portfolio. Is it 18 properties?
It's 29.
Oh, sorry, 29. Yeah, I forgot about those over 11. So that's a significant portfolio. And I know from my own personal circumstance that maybe once I hit 5, that all of a sudden I need my own process to manage these. You know, I'm dealing with different rental managers. I need to make sure that they're doing what they should be doing. I need to make sure that, you know, I believe that this property is cash flow positive. Is it actually, after all the expenses like rental management, insurances, etc.? How do you manage your portfolio?
It's just like you said, good rental managers. So they send monthly statements. You know, commercial is done in, like, I have it in family unit trust, so you've got to do quarterly BAS statements. So you send your accountant, you know, the quarter's rent, and, you know, there'll be those statements from the manager. They add it up, they do the tax for it, and it happens, you know, smoother than you think. Like, it's, you know, you do as much communication via email as well. You know, so you just yes, no, you know, approved, not approved, things like that.
That's very short with them, eh?
And like that, I find it works. So you just need a good trusted rental manager, and if their service drops, which they do because they get busier, you know, like, you just got to be, you know, you got to be nimble and be ready to change managers because sometimes a fresh set of eyes is very good for the property.
Oh, for sure. Do you go through a qualifying process when you speak with a rental manager? Would you maybe interview 3 in the area, perhaps?
Well, I'm a little bit lucky because of my business. We buy properties all day, so I get to. We don't have to interview because we know in the market who's doing what. So, but if I was starting fresh, you just want to talk to someone you get along with. I like dealing with, like, directors of businesses too. So there's sometimes the smaller, more boutique companies, because if you have problems with a tenant, you want to be able to talk to someone who can pull strings to make, you know, get the solution.
Indeed.
You know, if you're with one of the large companies, I've often found there's a bit of a turnover, and the turnover of staff means your property just gets forgotten. They don't know who owns it. I've always liked that slightly smaller company.
I see. So does that mean that maybe you are moving away from the larger rental agencies, the Ray Whites, the LJ Hookers, etc., and those boutique, you know, like Bob's Real Estate in the local suburb, somebody like that? They've got skin in the game, right?
Exactly, and that's quite important for commercial as well. Like, and it can be a big company still, but you want someone, like, let's say you lose a commercial tenant, you want someone on the ground that he might have 50 other rentals in the area, so he knows who's looking. And he might be able to or she might be able to call a specific person and say, do you want this property to rent? Rather than just whack it up on...
Put it on the market and wait a month.
So a little bit more targeted, and I think those types of local contacts are good like that.
Okay. Does the location of the commercial property matter?
It depends what type of property it is. So retail, for instance, I wouldn't go buy a retail shop front in Moree, you know, middle of nowhere, because it's you know, it's hard to find tenants out there. It's not a real, you know, I like capital cities in general. If you go regional, that's fine, but big vibrant regional towns, which you know, growing population.
Is there a rule of thumb for maybe the population that you should stick to?
It's because it's so specific. Like, there's no general rule of thumb. Like, you might have a Woolworths in a very small town, but that works. But, you know, if you had a very specific type of tenant, it might not work. So it's not as simple as
case by case.
Yeah. But the bigger the town, the better in general. But it's supply and demand. And the thing that people forget with commercial is you've got to look at the supply of the same type of properties on the market and the demand for those types to rent. So if tenants are looking for an industrial warehouse and there's none available, rents are going to grow because they're going to pay for more. That's a good sign.
Okay.
And it doesn't matter if the town's a bit smaller, if there's a shortage of that and there's no supply coming onto the market, you can feel comfortable that you're going to find tenants quick, plus get rental growth. So supply demand is key to work that out.
Is it? Does it operate similar to residential, whereby there could be, now some people don't believe in this, but the concept of the property clock, for example, so everything works in cycles. Is that the same for the commercial industry as well?
Yeah, look, it's very attached to the interest rates. It's attached to infrastructure spending. It's like job growth. It's, you want to look at the indicators. I like population, infrastructure spending, income growth. Those are nice indicators. And when interest rates are going a certain direction, that's just a bonus.
Okay.
But look, there's some properties that don't really matter with that. Like if you go buy a doctor's surgery, that's been there for 30 years. There's no property clock going on there. That's just going to be the CPI or 3 or 4% rent growth each year. So, population growth could affect that. But you can see it's very case by case, and that's where that's why I love commercial property, because every single property you look at, it's totally unique. And it's not like when you buy a house, if you work out what a good suburb is, all you're really doing is trying to buy a house that's in good condition at the right price. Once you've worked out the suburb. When you look at commercial, it's, you've got to look at far more things, like is the business viable? Do they have a succession plan? Are there competitors coming up? Is in 10 years this industry going to vanish because everything's going online? You've got to find it a little bit.
Does that maybe mean that you need to be, I suppose, more in line with understanding profit and loss accounts, and maybe that's more suited to, I don't know, like entrepreneurs, business owners themselves, because they can appreciate what is a good business and what's a stable business. They can maybe read the economy as a whole.
So I find a lot of my clients that actually jump into commercial are business owners, or they've rented and they've paid an office lease. So they've got that mindset. A lot of trade type people like warehouses, for instance, because they appreciate the value of them because they need the space as well. So once there's that personal connection, it's easier. But outside that, anyone can learn it. It's just a matter of, you just find what you're comfortable with. A lot of people go, I only want to buy a dentist, because I understand it's a destination type property where you have to go to see that person. That means that type of business won't go online.
So there is actually investors out there that niche down so much. So they're not just within commercial, but I'm the dentist investor within commercial.
Yeah, some people have that, and then. Some people only want legal firms, for instance, because they, it's a fairly rock solid business. Depending on what type of law they're in, it can even be certain to a certain degree, like recession proof as well. Accountancy firms are quite solid. So people have comfortability. Some are open books, and then we can just literally show a few different options. And it's just finding what you're comfortable with, what you can understand, and once you understand it, that's where it becomes less nerve-wracking to purchase, and you're really just looking at the numbers after that.
Now I know that in your past life of residential investing that you've created equity through strategies such as strata titling units, blocks of units. Now, is there such strategies available to us through commercial?
So I've created a lot of equity through things like rental increases. My first commercial property was in Perth. It was a supermarket, like a 400 square metre one, small one, like a super deli they called it.
Indeed.
And it was on it had 9 months left on the lease, which is no good. So I took the risk.
But why did you take that risk? Was it a super high yield?
It also had another tenant, so there was a fish and chip shop, so it was a multi-tenant. So I thought, look, worst case, if this guy goes under, number one, I feel like there needs to be a business here. So there will be a position to look for another tenant. And then there was a guy that was there for 18 years, fish and chips. So that was half, not quite half the rent, but enough to keep things going.
Give you confidence,
But we also called them up and they said they were going to stay. So it was worth it, and ended up signing a 5 plus 5 year lease.
Now, as a result of that, because the lease was nearing its expiry, was the value lower? Because the valuation was not based on that 15-year lease.
Yeah, and think of it this way: like the shorter the lease, the less attractive it is to investors.
Yeah.
So when you expand leases or make them higher in value, that makes the property more attractive to investors, which on paper should make it more, be worth more.
So could that be the equivalent of, in the residential space, say I've got a property in a half decent location, I know that I'm going to sell it, so you know what, I'm going to do a cosmetic renovation.
Yeah.
I'm going to paint the walls, new carpets, etc. Whereas if I've got a commercial property, I'm going to sign the tenant up for another 3 by 5 year lease and then put it on the market, because that's going to build in some additional equity.
Yeah, and another, like, you can still do renovations too. The reason for it is you could make, like, we just buying this small, like it's got 6 tenants in it up in Brisbane, and it's just been run down a bit because they haven't looked after it, but all the tenants are in there happy. The strategy for our client is to render the outside of it, because it's sort of a red brick, not too attractive.
Okay. Yeah.
New carpets, paint the walls, and that will give us more of a case to go back to the tenant and say that we need extra rent, because they're a little bit below market value. Making them feel like we've spent money, it's better than asking money for nothing. If you've done work, improved the property, it makes their business look better.
Could you maybe consult with the tenant and say, well, what's missing from the property? What do you think will enhance your position within the property?
For sure. Like you just want to create a win-win.
Yeah, definitely.
And if they're happy with what you're doing, that will give you a case to try to get them on a longer lease.
Yeah.
So it's all, that's all part of it.
And so I suppose it's different in that, so you're not renovating the property to get it revalued by the bank to pull out equity. You're kind of going, okay, we'll renovate the property, we'll improve the lease, then could you refinance the property and get it revalued?
Yeah, definitely. So you can get, like, valuations are a lot more thorough, I believe.
Is it every year is mandatory?
Look, the big managed funds in the city who've been under management will value every June 30, because they actually rely on a revaluation to pull out money to distribute to their investors.
As dividends?
As dividends. So they've got the cash flow component and the capital growth component. So to get the capital growth component recognised, it needs a valuation by an independent valuer.
Indeed.
So these take into account the rent, the length of lease.
So does that mean that they're refinancing every single year?
Potentially, yeah.
Yeah, wow.
So, and they run at sort of similar debt levels. So, they might be a 55% debt level on those. Okay. So they keep it at that, roughly, because it's an efficient way of stretching the money too, because you don't want a property with no debt. You'd rather split the other half and have another property. I think that's even, from a conservative point of view, you've got an extra type of property renting, the low debt levels are quite safe in that sort of scale.
Have you refinanced any of your personal commercial properties?
Only once. So I did refinance that one where I got the lease
in Perth.
Extended. So that had an uptick of about sort of 15% from that, which was good in a flat market.
Yeah, indeed.
And other ways to make equity in commercial would be buying like a little neighbourhood shopping centre, strata titling it. So it's like buying a pie and then splitting it up, because it makes, getting it into bite-sized pieces means more investors can afford the cheaper ones.
Yeah, indeed.
More competition at the lower price point, yields are smaller. So you might buy it at an 8% net yield.
Yeah.
But you can sell the pieces off at 7%. So that's a percentage gain just from chopping it up to a smaller.
And might it be a similar process to residential, whereby, okay, maybe we'll need to speak with a surveyor, we'll need to see if it's BCA approved firewalls need to be put in place?
It's exactly the same.
Yeah, okay.
Exactly the same. And it's good, even from a financing, like residential, I had success with that because it was hard to finance a unit block, especially when it was over 4 units on one title.
Yeah.
So there's a less competition in that space, but compared to a 2-bedroom unit, much easier to finance. So you can buy it at basically a discounted rate when you're buying it all in one. Chop it up. You've got to spend money on, like what you said, firewalls, council fees, etc. Yeah. So it doesn't work in every property, but and there are sort of negatives to it. Like when you split it up, you've got extra rates to pay each year, so you might want to be splitting it up to sell it rather than just split it up to revalue, because it will hurt your cash flow.
Yeah.
But then again, like financing might be easier if you split it up anyway, and you can have standalone loans. Like there's all sorts of things that can come.
There's different benefits. Okay, lovely stuff. Well, if people want to learn more about commercial property and get in touch with you, how can they do so, Scott?
Probably just go to the website, rethinkinvesting.com.au. We've got all these different previous client deals people can look through, so they can just see the current numbers in the current market. We do a lot of warehouse stuff, medical stuff, even larger scale things like small shopping centres, and it's quite popular at the moment, and interesting space to be in.
Awesome. All right, well, thank you so much for your time today. I appreciate it, mate.
Thank you.